Hey guys, welcome to Pounds Invested, your place to learn about economics, finance and investing. I'm your host, Stephen Georgiev. Now, before we get into today's video, I really want to thank those of you who have watched my other videos and who have liked them enough to subscribe to my channel, so thanks a lot. So, in today's video, we're going to talk about different investment strategies depending on the age of the investor. Now, I know that most of my audience is in their 20s and 30s, but I thought it would be fun to make a video looking at investment practices for other age groups as well. So, let's get into it, shall we? Now, for context, we know that in the UK, only about 3 or 4% of the population actually invest in the stock market, be that through an ISA or through a SIPP, or God forbid, through a general investment account. Now, regular viewers of my channel will know that this approach is literally insane. So what's wrong with this approach of just sitting on the sidelines and not actually having invested? Well, we know that your biggest investment building tool is having spent time, decades, invested in the market. So by not doing so, 96–97% of the UK population are missing out on all of their investment returns. But not you. You are smarter than that, because you will have an ISA or a SIPP or a general investment portfolio account. So first off, let's say you, like me, are in your 20s or maybe your early 30s. What's the best investment approach for you to take? Well, the investment goal while you're in your 20s and 30s has to be long-term growth of your investment funds. Now, because you're targeting long-term growth, that means that you can take a risk-on approach. What does that look like in practice? Well, it means that you can afford to be a little bit more adventurous with your investment portfolio. You can load it 80, 90, even 100% full of stocks if you wish for a few years, and get as much capital growth as you can without necessarily having to worry about pullbacks in the market. Why should you not be worried about market corrections? Well, quite simply, if you're in your 20s and 30s, that means you potentially have 4 or 5 more decades of investment time horizon. And during those 4 or 5 more decades, the market's going to go up, it'll come down, it'll go sideways, it'll do all this kind of fun stuff. But in fact, all you need to do is stay the course. All you need to do is keep ploughing on every month, investing the money that you set aside, adding to your investment portfolio, and over time, it'll keep growing. And let's not forget the golden rule of stock market investing. Time in the market is more important than timing the market. So let's say you're in your 20s and 30s. What could your investment portfolio look like for that 10 or 20 year period? Well, one idea might be for it to look a little bit like this, with the vast majority of it, like I was saying, 80, 90, even maybe 100% if you're adventurous, invested entirely in equities, which would then leave potentially 10 or 15 or maybe even up to 20% which you can invest in other stuff. That might be things like property, it might be a little bit of an allocation in gold, particularly if you're quite a conservative investor. But by and large, at this point in your life, you should be as risk on as you're comfortable being, and that for most people will mean having the vast majority of their portfolio invested in equities so they can benefit the most from capital growth over the long term. Now, let's say you're a little bit older. Let's say you're in your 40s or 50s. What should your investment approach be? Well, at this point in your life, the goal is no longer long-term capital growth. When you're in your 40s and 50s, the goal changes and it becomes a mixture between capital growth and capital preservation. When you're in your 40s and 50s, you're much more likely to have responsibilities. What might that look like? Well, at this point in your life, you're much more likely to have a mortgage, you're more likely to have children. In general, you're much more likely to have financial responsibilities, which make it much harder to chase long-term capital growth by adopting a risk-on approach. So at this point in your life, therefore, you might think about adopting a medium risk approach. Now that doesn't necessarily have to mean retreating entirely from equity markets. In fact, that's probably the wrong approach to take. Rather, you're much better altering your portfolio dynamics slightly. So rather than having 80, 90 or 100% of your portfolio invested in equity markets, maybe you just dial that down a little bit to 70 or 60% invested in equity markets, and around about probably 25-30% invested in bonds, and then the rest of it you can leave in property, you can leave it in gold, you can generally leave it in other assets. So by and large, by the time you're in your 40s and 50s, this is not really the time to be chasing the next big thing. It's not really the time to be investing in all of the new stuff that's coming around, unless you're feeling particularly adventurous or you very much know what you're doing. Leave that to those in their 20s and 30s who have a slightly longer time horizon to play with and so can take more risk with their investments. You, on the other hand, should be looking to balance out risk and reward so you can be in the best position going forwards into your 60s, 70s and beyond. So what might your portfolio composition look like? Well, one idea might be for it to look a little bit like this. Okay, so now you're in your 60s, you're in your 70s, you're perhaps in your 80s, maybe even beyond. At this point, what should your investment goal be? Well, I'd suggest at this point in your life, you're no longer interested in capital growth. At this point, your aim has to be capital preservation. Because what you don't want is to be invested in the wrong things, chasing capital growth over the next 10 or 20 years, when in fact you only have a 10 or 20 year time horizon going forwards. So at this point, you want to dial down even further your exposure to equity markets from 60 or 70% to maybe 40 or 50%. And so that means by the time you approach retirement in your 60s and 70s, your investment goal has gone from making 10 or 12% or more per year, like you were aiming to do in your 20s and 30s and 40s, to making 3, 4 or 5% per year, just in order to keep your portfolio above inflation so that it doesn't actually reduce in value as time goes on. Put another way, at this point in your life, it's probably best not to be thinking about the daily, weekly or monthly gyrations of financial markets. Purely, you simply want to be in a position whereby you can afford to live off your investments that you've made over the past 20, 30, 40, even 50 years for the 10 or 20 years you have left, to be able to do so in comfort. And so, what might your portfolio look like in practice? Well, I'd suggest, like I said, that it might look a little bit like this. So, there you have it guys. We've been through what your investment goals should be at different points in your investment journey. From your 20s and your 30s, where you're chasing long-term capital growth, through your 40s, your 50s and your 60s, where you're balancing out capital growth with capital preservation. And then as you approach your 70s, your 80s and beyond, we are much more focused on capital preservation. So that's all I have for you this week guys. If you found this video useful, be sure to smash the like button to let me know, and also for more content like this, you know you want it, be sure to hit the subscribe button and also smash that notifications bell so that you're kept in the loop whenever I post new videos. And with all that said guys, I'll see you in my next video in a few days' time.